Welcome to my channel, the Religious Investors Forum and God, Man, and Money series. Thank you to those of you who have subscribed, and I invite those others who have not to subscribe and join me on this journey. So in this series, I'm going to be talking about a very, very important matter, and I'm going to be making a case for a recession. Let us have a recession is the topic of this series. You'll be surprised that I'm calling for a recession at this time when, um, in fact, after I had already taken a position with those who are saying that a recession is unlikely or um, and so on. But the new awareness and education and learning and my new thoughts about the whole situation is the reason why I am looking at the topic, looking at the situation differently now. So I want to establish a case for the benefit or the advantages that could accrue from having a recession versus not having one. So I'll be making this case under three subtopics. One is like I'm going to do a reconsideration of how we understand the stock market. And secondly, I'm going to be talking about the conditionalities for a recession and whether these conditions have been met or not, and what are the issues with them. So, and then finally, I'm going to focus on the effect of debt, inflation, and debt relief that could be associated with a recession. So let's talk first about how we understand the stock market. This could be a very long discussion, but I'll make it as brief as possible. What we call the stock market is actually not about stocks alone. And so don't get carried away from the title of the name that it is a stock market. It's actually, the stock market actually has three major components, and at least two of them, they are like equal or like the one with the most impact on the direction or the trends of the stock market, and that's bonds. Bond is the stock market is also a bond market, and we know what bonds is. Bonds is like the lenders provide money to the government or corporation or any of those entities, and in exchange for that money, they get a yield that is sometimes analyzed at a certain percentage of that money. And at the end of the term or at the end of the agreement, which is usually 2 years, 10 years or 20 years for the most popular yields, or treasury bills and so on. So that's how how bonds operate. And the stock market is also the place where this is sold, and is part of the. So when you start a portfolio, I think about 3 years ago when I started on this journey and started to be educated about it, they will tell you that for you to set up a successful portfolio, you need a certain amount or certain percent of stocks and bonds and some other financial instruments in your portfolio. So the role of bonds is actually there and felt and take and factored in the performance of stock market and in the performance of an investor's portfolio. The fact that we in the religious investors platform, we do not invest in bonds is not a reason for us not to learn about the role of bonds in the market, in the overall market, and in the trends in the market. So, and I've talked about this a lot in previous releases. So, but what happens now is that stocks and bonds do not interact cooperatively. As a matter of fact, one of them, when it rises, it pulls down, it pushes down the other, and it's like a tug of war between the two of them. And what we're witnessing now, because I don't want to spend too much on this, is what I would call the reign of bonds. The reign of bonds. The reign of bonds occur because people are plowing back money from stocks into bonds because of the effect, because of inflation, and because of the increase in the interest rate. All of these make bonds to be more attractive to investors than stocks. And as a matter of fact, those of us that only have stocks in our portfolio, we know what it means, because many of those stocks are down, and they are down terribly. And don't be deceived by the performance of the so-called Magnificent Seven. Only about 2 or 3 of them actually put off something substantial, and that's probably been reversed now. So when the bond is on the rise and waxing, um, you know, stocks are winning and stocks are going down. And you can see the downward pressure on the stocks for almost like 18 months or about 2 years now. So that's about that. But let's go into the second dimension of this topic, which is the conditions that are being mentioned by experts for the occurrence of a recession, and how much of this have actually come to pass. The three major conditions is about what is called what is called the inversion of the curve, and the other one is drop in the GDP, and the last one is the decline in the employment rate or employment level. So let me start with the last one, which is the decline in the employment level. We have a very robust economy, so to say, and we have a very resilient economy also. The effect of the action of the Fed, the Federal Reserve, which is manifesting in the increase of interest rate and all of these things, has not really is meant to force the employment level to decline, but that's not been achieved very effectively. And I think the last data about employment was the only one that could have raised any glimpse of hope that employment market is going to be on the decline. Each time they have issued this report, it's come higher than expected, showing that the economy is strong and forcing or stringing the Federal Reserve to continue to raise the hikes until their last meeting. So the second one, which is the decline in the GDP, that also has not actually occurred in any significant manner. In fact, you could say that it is the reverse is what is happening now. The last two GDP reports that we have, the last but one that was expected to be negative was actually about 1%. And the second one, which is the last one that we have now, actually shows the U.S. economy growing at a 3-point-something%, the GDP growing at a 3-point-something%, which is a very high, which is very, very clearly not a negative, not even a weak, a poor one. And not a lot of countries' economies can boast of anything like that. Not even China, that has a faster growing economy, except for its future projections and predictions. So we are having problems with this, and that's forcing but the inflation that continues to be on the rise, and the interest rate that continues to be on the rise, and the increase by the Fed, they are the major two actions that are interacting with the market and forcing us to creating a kind of stalemate in this matter, in the movement or direction of the market, as regarding whether the market is going up or down. So the last one, which is the inversion of the curve, is also very interesting, in the sense that the inversion of the curve has occurred for over several months now. And the experts are now telling us that the inversion of the curve, which is when the shorter term bonds are producing greater yield than the longer term. So when, say, like 2 years, 10 years are giving you more money, more yields, more interest than the longer term. That has occurred, but they are telling us that inversion of the curve in itself is not a conclusive sign, and that the curve has to re-invert. And we've been waiting for the curve to re-invert, and that waiting has been much longer than any of our recent experiences of this event. So taking all of those things together, you could say the recession is unlikely. So that leads me to my third point, that I'm going to be able to tell you that whether this is, regardless of this situation, we still need a recession. And that's about the effect of debt on our economy. Ours is a debt-driven economy. And let me give you one example. We're saying that the federal government has accrued a lot of, trillions of debt, that our, debt has increased over the time. But what they're not telling us, or what I want you to pay attention to, is that it's not just our government that is accruing debt. We as individuals, and more importantly for the market, the corporations, whether they are the large cap ones like Amazon, like Microsoft, like all of these, Google, and so on and so forth. All of these companies too, they have massive debt in their balance sheet. And so, but this might not be a big problem for the economy, because but when you look at the mid cap companies, or the small cap companies, which we call the growth stocks, and the companies in the 100 in root, and all of these other companies, but they all have massive debt. They all operate on debt. But what is worse than that is the startups. And fortunately or unfortunately, many of us that are new in the market, we want to invest with the startups, because that's where we can expect to 2x, 3x, 4x, up to 10x of our investment. But these startups, they don't have profit, and they are not productive yet, and they are burning money. And the stocks are down. Some of them are down like up to about 70, 80, 90%, which means that the share that you bought for $10 is now worth more than $2 or less now. But the more serious thing is that all of these corporations, whether the large, the mid, the small, or the startups, the effect of debt is a heavy burden on the neck. Let me take an example from the large cap, like Amazon. So the latest analysis that we've received, that we've learned from some of our experts and instructors, is that even a company like Amazon may not be able to survive much in this type of environment, because they have a large debt, a large amount of debt that they cannot say, okay, I'm going to pay it within 1 year or two, especially at the time when the cost of production is rising. And they are going to have to refinance this debt in the next 1 year or two. And if the situation remains like this, it's going to prove very difficult for them. So when you think about the behemoth, that they are not free from that problem. So that will tell you how much serious this can be for the startups. So a lot of startups are dying, and then in addition to that, that like we just said about bonds, the reason why many of our banks have failed, and I have a new list of other banks that will fail very shortly, about 10 of them. So is because they buy debt and resell debt. And when it becomes much expensive to buy debt and to service debt and to pay interest on debt, and they have to they're not able to buy whatever they are owing, they want to sell it at a higher interest rate. That's why you have the mortgage rates and all of these things. And when you combine that with all of the debts that Americans are having, whether it's a mortgage, car loan, student loan, and all of these things, and all of these things becoming a problem because the interest upon them is on the rise, and the chances of refinancing is slim, is not non-existent. Or you think about that for the startups, the little company, the little guys on the Wall Street. So you can see that they are actually suffocating and they're dying. But when we have a recession, the the question becomes a little more easy to diagnose and to treat for the because the Fed has only one surefire tool, and that's the interest rate. Now, when there's inflationary trends like we have been seeing, we've been living and experiencing, they increase the interest rate to force a lot of things down, not minding whether something breaks or not. But when we have a recession, they are forced to stop raising interest rate. Actually, they are encouraged. They know that the only tool they have is to pivot. It's actually to not just pause increasing the rates, but start cutting the rates. And when rates are being cut, a lot of companies will begin to have a sigh of relief, and so they don't have to they become much easier for them to continue to borrow, or at least refinance, or at least get their balance, start getting their balance sheet in order. So if you don't have a recession and we patch up this crisis, it may benefit some companies, especially the large ones. But sectors of the economy like the real estate, which is what I call capital intensive, but in my own understanding, debt intensive, they're not going to be able to survive. And so a recession will be a complete reset, and a recession will be, in the kind of analogy that I'm trying to provide, is that give the doctor the chance not just to treat an ailment or a disease, but to do all kind of diagnoses and treat all kind of other conditions that may be not in order with the patient. So it is true that the recession is a bitter pill to swallow, but sometimes it might be the solution. So thank you for listening, and thank you. And I really would like you to give a thought to this, and if possible, provide me with your own, or what do you think about this? Thank you very much. God bless you. Bye-bye.